So in this section of the video, we are going to look at Islamic finance. So Islamic finance is a finance that is compliant with Sharia law. Islamic finance has gone through an exceptional growth period in recent times. The number of fully Sharia compliant banks continues to increase worldwide. Sharia compliant financial products are not only offered by Islamic banks but also offered by conventional banks. So here you could see how the Islamic finance is like growing over a lot of countries. So Islamic finance accounts for 20% of banking system assets in 10 countries. So these are the countries which are like mostly using Islamic finance. And the global assets in Islamic finance seems to be keep on growing. So this is a chart from 1 to 2011. So we look in detail like what is the theory behind Islamic finance. So the objective of an Islamic finance undertaking is not only to just make profit but also to achieve goals such as social welfare and full employment. So this is what differentiates between conventional banking and Islamic finance. Making profits by lending alone and charging of interest is forbidden under Sharia law. Islamic finance company should not make profits by lending, and charging of interest is also forbidden in Sharia's law. Again, this is a huge difference between conventional finance and Islamic finance. The business of trading of goods and investments in Sharia's acceptable enterprises form the core Islamic finance. So what happens here is Sharia and Islamic finance is like promoting the trading of goods and investments, but they prevent interest being charged. The Islamic bank arranges their business in such a way that the bank's profitability is closely tied up with that of the client. So interest is not charged, but the any profit which the client of a Islamic finance bank makes, that profit is like shared with the bank. The bank stands to take profit or make a loss in line with the projects that they are financing. As such, must be more involved in the investment decision. So the bank is not giving a loan, the bank is actually making a investment in the project. So these are the key differentiating elements between a conventional finance and a Islamic finance. So this we can say as the 5 pillars of Islamic finance. So the first one is each transaction has to be backed by a tangible and identifiable underlying asset. All parties must share the risks and rewards of a transaction. Certain items should not be like financed or traded. For example, alcohol, weapon, pork, gambling, internet-based financial institutions are to be not to be invested. Ban on speculation. Uncertainty is contractual terms and conditions is prohibited. So the speculation is like banned. Ban on interest. Interest must not be charged or paid. So these are the 5 pillars of Islamic finance. So we look at the various Islamic finance contracts. So these are the ones which form the part of your exam. So there's something called as a Mudaraba, which is a partnership contract. Musharaka, which is a kind of a partnership, again a kind of a equity partnership contract. Murabaha, a form of credit sale. Ijara, a form of lease. Sukuk is a type of bond. So this is a very important part of the Islamic finance. So here we will discuss each type of contract in detail. So Mudaraba is a 2% partnership contract. So a Mudaraba transaction is a partnership transaction in which only one of the partner contributes a capital and the other contributes a skill. The investor has no right to interfere in the day-to-day operations of the business. The investor heavily relies on the working partner and his ability to manage the business. Investor in Mudaraba is only liable to the extent of the capital he has provided. As a result, the working partner cannot commit the business for any sum which is over and above the capital provided. So Mudaraba is something like a private equity investment. So this is what Mudaraba is all about. We move on to Musharaka contract. It's a many person partnership. All partners bring a share of capital and expertise to the business. Partners do not have to provide equal amount of capital or expertise. Any profit will be shared according to the ratio agreed. Any loss will be distributed in terms of the capital alone. Although profits can be distributed in any proportion by mutual consent, no lump sum profit can be shared by a single partner. So why do they have it? Because one person should not enjoy the profits of a business alone. This transaction is like very similar to a venture capital. So this is about Musharaka contract. So now we'll move on to Murabaha contract. It is a form of a credit sale. As part of the contract between the buyer and the seller, the price and the quality of the goods, the markup, the delivery date, the payment date are agreed. The sale of the good is immediate against future payment. In the context of trading, the advantage to the buyer is that he can use the goods to generate a profit in the business and subsequently use the profit to repay the original seller. The underlying asset can vary. It can include a raw material or a goods for resale. So this is how it works. So the seller and the buyer determine what is going to be the price, the quality, and the markup, the delivery date, and the payment date are all agreed, and the goods are delivered from the seller to the buyer on credit. So it is a credit purchase for this person and a credit sale for this person. But the thing is, there's no interest charged. Okay, but the profit earned by the buyer has to be shared. It has to be shared. So what happens is, assume the price of the good is 100. He has sold it for 100 to this person. This person in return, when he pays back for the good, has to pay more than that. For example, 100 plus some 5, so 105. So this 5 typically represents some kind of interest. But if you look at this, assume the buyer could not make a profit. He has made a loss. In that case, he has to just repay the original amount. He won't pay the additional amount. So what we thought as an interest is not an interest at all, because whenever the profit is made, it is shared. Whenever a loss is made, it doesn't need to be shared with the credit seller. So this is a form of credit sale. And there is also conditions regarding the Murabaha sale. For example, the object of credit sale must actually exist and should be owned by the seller. It should be offered for a price, and both the object and the price are accepted by the seller, and it should also be within the market range. The object that is being sold should have some kind of a value. The object in question should not be prohibited by Sharia. For example, pork or weapon or alcohol are not are prohibited by Sharia law. The buyer in the contract has the right to demand that the objective is of suitable quality and is not defective. So these are the conditions which are required for a sale. So we will move on to the Ijara contract. An Ijara contract is where one party, the lessor, allows another party, a lessee, to use his assets against a payment of a rental fee. The asset needs to be tangible, non-perishable, valuable, identifiable, and quantifiable. The lessor leases the asset to the lessee for a pre-agreed period, and the lessee pays a pre-agreed rental. So it's a normal form of a lease contract. The rental or lease payment can either be fixed or floating. At the end of the period, the lessee can request for an extent of the lease or hand the asset to the lessor. We still have some more points. So this is how it works. The lessor gives the asset to the lessee. The lessee makes the periodical rental payment every year. At the end of the contract, the asset is transferred. So there are like still more conditions here. In both the forms of Ijara, the lessor is the owner of the asset and incurs all risk associated with ownership, while the lessee bears the responsibility for wear and tear and day-to-day maintenance. The lessor is responsible for major maintenance and insurance. Due to the fact that the lessee is using the asset on a daily basis, he is often in a better position to determine the maintenance requirements and is generally appointed by the lessor as an agent to ensure all maintenance is carried out. So we'll move on to the Sukuk Islamic Bond. So this Sukuk Islamic Bond is like very different when compared to a normal bond. Sukuk are normally linked to the underlying tangible asset. The ownership of the underlying asset is transferred to the holder of the Sukuk certificates together with all the ownership benefits and risks. This gives Sukuk the characteristics of both equity and bond. Sukuk have a short term than conventional bonds. They are typically 3 to 5 years in nature. Sukuk holders own a proportional share of the underlying asset and the income that it generates. Sukuk holder is also subject to ownership risk, which means that he is exposed to any risk and potential loss associated with the share of the underlying asset. So these are not like normal bonds because there is no interest involved, but what is involved is the sharing of profit and loss. So even though it has a name like bond, it is still seem to be like a equity, but a very short term equity, and that too is payable within a period of 3 to 5 years. So that's why they say that it is a combination of both equity and bond. So now we will summarize all the Islamic finance contracts. So Murabaha is a trade credit or a loan. Musharaka is similar to a venture capital. Mudaraba is equal to equity. Ijara is similar to leasing. Sukuk is similar to bonds. Okay, so this gives you a good summary of the entire contracts. So we'll have a quiz. A type of partnership where one party offers funds while other gives expertise and management is called as, okay, so the contract is Mudarabaha. Giving share of investor to customer on lease. Okay, giving share of investor to customer on lease. So the word lease is there. So lease is the basis of Ijara. So any lease is Ijara. So we got the answer. So we'll move on to the next part. So in this section we'll be like looking at the finance for small and medium sized enterprises, which is called as SMEs. So what is an SME? So SMEs are business whose number of employees fall below a certain limit or the revenue of the business is within a defined limit. So these are like small companies, like a small factory or a small trading company. So these are called as SMEs. SMEs are larger than self-employment of their owner. So it is not a one-person company or a freelancing business. It is more than that. SMEs are unlikely to be listed on any stock exchange and is likely to be owned by a relatively small number of shareholders, usually by an extended family. So usually these are like family-owned businesses, and if they are not owned by family, it has a small number of shareholders. SMEs outnumber large companies by a wide margin and also employ more and many more people. So SMEs are like very large in numbers. For example, for every one MNC company, there might even be 100 small and medium enterprises. And if an MNC is going to employ around some 5,000 people, SMEs would employ around some 5 lakh people. So that is the size and potential of a SME. Even though each business in SME will be like having 20 employees per business, but still when combined together the SME strength is much more higher. For example, Australian SMEs make up 98% of all Australian business, produce one third of the total GDP, and employ 4.7 million people. So we look at how the SMEs are like financed. SME finance is the funding of SMEs and represent a major function of the general financial market. So SMEs have some unique financing ability. For example, they are financed based upon the collateral they give. For example, their factory or their asset. Information. For example, their credit rating. Any credit rating that they have, based upon that they might be given a loan. Or viability. If they have a project to produce a particular product, based upon that they might be given a finance. So this is how SMEs are financed. So finance which are accessible by SMEs, from where they get their money, they usually get from bank loans and overdraft. They get from leasing, hire purchase, equity share or bond, corporate bond issue, but this does not include the IPO and all, because they are a very small company. Venture capital or private equity, they can go for asset based finance, such as giving collateral and getting a loan, or they can also sell their receivables like factoring and invoicing, or they can get government grants and loans. So these are the forms of finance which are usually accessed by SMEs. But there's something called the SME finance gap. Conventional financial markets, okay, a market where a large company can go and get finance, those finance is called as conventional finance market. This market is not available to the SMEs. This is due to the lack of security that they have. So they might not have a lot of machinery or factories, so the security that they can give is limited. They might not have high returns as like a big company. They might not even have a proper information to create a credit scoring, because they don't have any compulsory auditing or anything like that. So they might not have information to get credit scoring. They don't have internal control at all. They don't have external controls like auditing or annual reports, and usually the owner is the one who is dominant, and they don't have any professional setup in the company. So because of these things, it is very hard for the conventional finance market to give loan to this sector. So these are the SME demand side issue, what the problem which the company faces, SME companies face. So they get the requirements to get a loan or a finance is like very difficult for an SME. The process is very slow. There's a high cost for them to raise interest. There's a fear of decline in the business and low business and financial literacy. So these are the problem. On the other side, the problems which the banks have in supplying the finance to the SME is they feel the SMEs are high risky, Hence, the cost of giving them a loan is also high. The SMEs have a low revenue, and it is very difficult to reach these SMEs and give them a loan. And the sector is mostly informal in nature. Okay, so both these parties are finding it difficult to come to terms to get a finance. So this is where like alternative channels are available for SMEs. So one is business angel financing. An angel investor is a wealthy individual who provides capital for a business, usually a startup business, in exchange for convertible debt or ownership equity. So angel investors usually give support to startups at the initial moment where the risks of startup failing are relatively high, and when most investors are not prepared to back them. So that's why they are called as angels, because when other people are afraid to help them, this angel financing helps there. Usually they organize themselves into angel groups or networks to share investment capital as well as provide advice to their portfolio companies. Once a business angel is interested, they can become very useful to an SME as they will have a great amount of business acumen and they are likely to have many useful contacts. So now we'll move how the government helps the SMEs. So SMEs are helped in terms of providing grants. They help them in terms of giving uh, tax breaks. That is, SMEs don't need to pay tax. Governments also provide advice. Also, in terms of the government also gives a guarantee for a loan. The government also provides equity investment for some companies. So this is how the government helps the SME sector. So we will move on to the supply chain financing. So in supply chain financing, there are like three parties. One is the supplier, and one is the buyer, and the other one is the partner financial institutions. So the buyer buys goods from the supplier on credit. So it's on credit. Okay. So the supplier sends the goods to the buyer, and the buyer accepts the goods and comes to pay at the invoice date. The buyer then sends the invoice to the partner financial institute. So what the partner financial institute will do is he will accept to pay on the invoice date. So on the date of the invoice, what happens is the payment is requested by the supplier to the financial institute, and the financial institute makes a payment. Okay, he makes the payment. So what's the good thing about it? Normally suppliers might not sell goods to the buyer on credit, but in times of that kind of problem, the buyer can contact the partner financial institute, and the partner financial institute will then make a payment to the supplier. So this helps the buyer to keep on rolling his factory and his company. So now we look at the theory part of it. It is a form of financing that allows the manufacturer and distributor to buy raw materials in order to build inventory or fulfill large orders. It works by partnering with a finance company that extends trade credit, and it acts as an intermediary between the SME and the supplier. Whenever the SME needs to buy raw materials, SME places a purchase order to the suppliers. Once the supplier gets the purchase order, they deliver the goods to the SME. The supplier issues an invoice to the financing company. The finance company pays the supplier. So this is how supply chain financing works. So now we'll move on to crowdfunding. So crowdfunding is a very interesting concept, and it is also one of the latest concepts in finance. So assume that you got an idea to start a business. Now what you do is you create a project on the internet. For example, there are like many crowdfunding platforms and apps are available. You go there and uh, you create a page for yourself. displaying your idea that you have. You tell a lot of crowd. For example, you once you created a project in this crowd financing website, you share it with your LinkedIn, your Facebook, and your Quora, and everywhere. And then the crowd, okay, the people who are interested in your venture, they will invest cash. And once the project is like kicked in and it makes profit, the profit is shared with the crowd investors. So your idea is now converted into a reality. So what is a crowdfunding and peer-to-peer funding? We'll see it in detail. Crowdfunding involves funding a venture by raising finance from a large number of people and is done over the internet. The internet platforms are set up and run by moderating organizations, which we can call as platforms. The platform brings together the project initiator with the idea and those organizations and individuals who are willing to support the idea. Different platforms have different policies with regard to assessing the ideas, seeking support, and checking those willing to provide the finance. Finance provided by the crowdfunding may be invested in debt or in the equity form in the venture. Some crowdfunding is done on the basis of keep it all. For example, if a particular project requires like 1 lakh, if this 1 lakh is reached, then we will run the project. Even if some 50,000 is reached, then the money will be kept by the person who raised the finance and he will still run the venture. In all or nothing, only if he raises 1 lakh, he will run it. If he raises 50,000, the 50,000 will be returned to the crowd investors. So this is called as keep it all basis. This is called as all or nothing basis. The crowdfunding platform takes a fee and it's usually a percentage of amount that has been raised. So in this section, we look at what are the various questions from this topic that have come in the past exams. So these are the questions. So J refers to June and 19 refers to 2019. So D refers to December. You can look like what are various questions that have been asked. So this part of the source of finance topic can come in 2 marks or 10 marks or even in 20 marks question, that is in section A, B or C. So you can look here, for example, this is a 9 mark. So in section C, this question would have appeared. 11 mark would have been for a problem and this 9 mark is a theory. So most of the questions have appeared like that. So this is another set of questions that have occurred. So this is a third set of questions. This is the fourth set of questions. So thank you very much for watching. We'll meet in the next video.